I'm Charlotte McLeod with investingnews.com, and here today with me is Peter Krauth, editor of Silver Stock Investor and Silver Advisor. Thank you so much for being here.
Oh, it was a pleasure, Charlotte. Thanks for having me.
Really good to be catching up with you here at PDAC, and it's not too long after our last conversation in Vancouver, but there's so much going on, so we'll see what we can get through today. I thought we can start with some timely news. So I've been talking to a lot of people about this flow of gold from London to New York, but I watched your presentation yesterday and you said silver is also in motion there. So what is playing out there? Maybe you can talk to us about the silver side.
So ever since now President Trump has been talking about imposing tariffs on other countries, and that is, for manufactured goods as much as it is for resources. There have been absolutely outsized historic amounts of metals flowing, gold and silver, from London, mostly out of London, where the larger inventories are, somewhat to Shanghai, but especially to New York on the COMEX. And so the thinking there is that anyone who needs to make delivery of silver in the U.S. wants to get its silver into the U.S. borders so that they're not slapped with tariffs. Because if you can imagine having to pay 25% more for your silver from one day to the next, it could wipe out some banks, it could wipe out some traders. And so we've seen these huge flows of silver into the U.S. A lot of it is actually being taken in physical delivery. So it's not just going on to the exchange, but some of it's just going directly into large private vaults. So we've not seen this really happen before. The COMEX is not meant really for a delivery type exchange like the Shanghai is. And so we're seeing that, and if we can talk about gold for a moment, the LBMA is now saying that when normally it would take them a few days to deliver gold, they're asking for 4 to 6 weeks. So a colleague of mine, another newsletter writer, Chen Lin, is saying they're technically in default because they should be able to deliver, let's say, within at least a week or 2 weeks, and now we're well beyond that. They try to downplay it, but it's not that the silver is, there is a very tight silver market, we can get into that, but it's not that this is tightening the supply, it's just that it's shifting it around. And since a lot of it is being delivered to physical, to vaults, to private vaults, a lot of this silver is in some way coming off of the market, not being made available for delivery. And so just the end of, just saw the numbers for the LBMA, they had the single largest drawdown. It was something like 71 million ounces came out of the LBMA for the month of January. It was the single largest monthly drawdown they've had since they've been tracking numbers back a decade. So again, these are very big movements and something to keep a really close eye on because it's making the silver market very tight. And what we're seeing too is that traders and people who are consuming the silver, like industrially, for example, they really obviously need, in that case, especially the physical silver. It's not just exposure to the silver price one way or another. They actually need the silver. And so we've seen the premiums go up. There's something called EFP, exchange for premium. And the premiums to have physical silver versus owning the silver through a futures contract have gone way up. So all these participants are starting to really want to get their hands on the actual physical silver. And that's what, there's a lot of talk about a lot of silver being leased out, having multiple claims on it. This is really starting to squeeze things and get, the silver market to pay a lot more attention to what's going on.
Yeah, I think it's very interesting to hear you explain it and a little bit more on the tariff situation. So there's a lot of uncertainty. We'll see how this plays out. But so we don't know right now if silver and gold will be included. We're still waiting to find out. So the resolution of this situation that could resolve it, or if there is no tariffs.
That's right.
that would be, but if not, then this continues.
Exactly, exactly. And so, I mean, if I'm, pushed to give an opinion, I do think that the tariffs thing will be resolved. I think that there's enough pressure, on the administration in the U.S. internally from manufacturers, for example, to say, you can't do this, you're killing our industries as well, by making us pay. There's a lot of resources that they really do not provide enough of internally in the U.S. They absolutely have to import. And so any of the industries that have to import these things, aluminum, for example, forestry products, there just simply isn't enough coming from the U.S. This makes their product from one day to the next a lot more expensive, and so they have to pass it on. Their prices have to go up. They can only eat into their margins so much, and I think they're just not going to sit back and let it happen. I'm sure they're putting pressure on the administration. I think we're going to see resolutions, 11th hour resolutions, backing off. Time will tell tomorrow. What are we today? The 2nd of March? March 3rd. 3rd already, so here we are. I'm losing track. Tomorrow is the day that we're supposed to know if they actually get applied or not. So we'll find out later. Your viewers will see this after, so hopefully I'm right. But I think it will be resolved. For me, I'm not sort of looking at the silver market from that perspective. I wouldn't even call it a bonus. It's just throwing things too much out of whack. We don't need these uncertainties. The world and these markets have enough uncertainties as it is. We need resolution. We need calmness. We need predictability. And I think that if you were to remove completely this whole tariffs characteristic or influence or driver right now, you still are in a situation where you have very, very tight silver markets that look like they're going to continue to be very tight for years to come. And so the picture is very bullish one way or the other.
Yeah, I think that's a good way to put it into perspective. So thank you for framing it that way. And a little bit more on tariffs. I want to bring it up because you had mentioned in your presentation yesterday, we've got inflation. It's slowly ticking up. These are projected to be inflationary. I'm wondering your outlook for inflation in 2025, and maybe we talk a little bit about what happens with the Fed in that case. Right.
So, anything near term obviously is harder to predict and to get right. But I do think that, if you look at how consumers are thinking and how they're reacting, it's University of Michigan does a lot of research on this, and they put out numbers for consumer expectations. They do surveys on this, and the average consumer in the U.S., despite, let's say, official numbers for inflation being right around the sort of 2.8, 2.9, 3%, are expecting that this year it's going to average 4.3%. So that's almost 50% above current rates. So they're not buying this 3% thing in terms of inflation. If you look at just the month of January, now I'm not saying it's going to continue at this pace, but in January in the US, inflation officially was up 0.5% for that month. If you annualize that, that's 6% per year. I just think that, we've seen inflation come down from its really high peak in July or so of 2022 at 9%. It dropped off dramatically. We've come down to, the sort of the mid-twos. I still think now that we're going to see 3% as the new 2%. Maybe eventually we'll see 4% as the new 2%. I hate to say it, but I think that, it's not. I'm telling you what I think. But if you look at what the average public that does not spend their days, researching this stuff and looking at these forecasts, they themselves are, I think, really feeling it, and that's why they see, inflation likely above 4% this year. And if you compare it, I think the best analog is the 1970s. And what you had was 3 successive waves of inflation: the late 60s, mid 70s, and then late 70s. And unfortunately, each successive wave was peaked at a higher level of inflation. So if we had 9% as the peak back in 2022, you can draw your own conclusions, but it's kind of scary. And I think we could, and we can have this in a slowing economic environment. So I think we're going to see a return of stagflation as well, like we had in the 70s. So slow and slowing economies, and yet inflation staying high and even rising, which is not a great picture overall, but excellent for precious metals and even resources as a whole.
Yeah. I was going to ask you about that 1970s analog because I was in the presentation yesterday. I almost wish maybe we didn't talk about that now because it sounds terrible. But as you said, so good for precious metals. So we've got that on our side. And I thought maybe we could review your price expectations for silver. Are you still, I'm sure it hasn't changed very much just from a month ago, but anticipating $35 mid-year and then potentially moving to 40 later on?
I am. We touched 35 last October. We had a huge run-up from February. I think it bottomed around 22, ran to 35. That's like a 40% gain. Not surprising to see these gains being digested right now and the silver price to kind of move sideways and consolidate. But the market is so tight, and I think that was one of the reasons that we saw that big move is the market or the participants are starting to see the tightness and the expected ongoing tightness. That was one of the things that got silver to start to move so much. That's not gone away. If anything, it's gotten tighter. So I think that to revisit 35 is very realistic and likely in the first half of this year. I think you mentioned the Fed before. The Fed likes to say that they don't pay attention to U.S. debt and they don't pay attention to the level of interest payments in the U.S., for example, but they are off the chart. The U.S. is now paying more in interest to service its debt than they're spending in defense. And so that traditionally has been sort of a turning point for an empire, so to speak, and that's when we can expect things to continue to degrade. Sorry, losing my voice here, talking too much. The Fed says that they ignore that side of things. I don't believe it. I think that they cannot help but pay attention because it's a spiral for the U.S. Treasury to have to pay. And think about it: the higher interest rates are, and they have to renew a lot of debt is coming due. They're going to have to renew it. Even if they renew it all at the shorter end of the curve, so short-term treasuries, we're still at higher rates in short-term treasuries. So as all of this debt comes due and they renew it, even at short terms and higher rates, they're going to be paying more and more and more to service their debt. So again, I cannot see the Fed ignoring that. They know it's, as I say, it's a spiral, a death spiral for the Treasury. I think that despite wanting to keep rates high because inflation is high, they're going to resume cutting probably later this year. And when you see them resume cutting, if this happens the way I think it will, in the face of sustained high inflation, they're going to lose all credibility. And I think that's going to be a really obvious trigger for precious metals. And you're going to really start to see funds starting to flow to the precious metals market and things start to move they've already done so tremendously for gold. Where were we a year ago in gold? 2,000 range or 2,800. We're looking at 40% returns. It's silver in the last year was up 44%. The S&P was up 22%. It essentially doubled the return of the S&P. So all of these indicators are suggesting to us that the generalist investors are starting to pay attention. The one, I think, big trigger that will make all of the difference is if we see general markets roll over. The S&P has been unable for several months now to take out its prior peak around, I think it was 6,100 or so in the S&P. We're at about 59 or so today. If we see it continue to stay weak and to continue to fall, you're going to start to see at least first the big money, the smart money that tracks all these different sectors, and they're going to move from what's been generating gains for them for the longest time, tech. They're going to start moving to deep value, and you're finding that right now in the mining industry. fantastic stat that was generated by a friend and colleague, Tavi Costa of Crescat. He went and looked in his Bloomberg at if the gold miners in the S&P were a sub-index of the S&P to just see how they perform versus the rest of the S&P and other sub-indices. They are the single best performing sector of the S&P. 40% free cash flows. I mean, nothing comes anywhere close to that. I think that's going to trigger M&A. They're going to use this cash, and when the market comes in and starts to push their share prices up, they're going to use their shares as a currency to turn around and start buying up smaller players and replace their reserves. And that means, investors can start moving down the food chain in the precious metals mining area.
Yeah, I think for sure you can see how that cascade could start to happen. So we'll keep waiting and watching, and we'll be checking in with you to see how this is going. On the note of silver, I wanted to bring up, since we spoke, we got the latest numbers from the Silver Institute. So I wanted to at least cover that a little bit. We've got our 5th consecutive deficit coming up, but quite a bit less actually than 2024. So what's your take on those numbers?
Well, I think that they're expecting industrial demand to come off a little bit. They're expecting, to go up, but they're expecting investment demand to come off a fair amount, and that kind of makes up for it. But what I found interesting is that if you look further down in their forecast, in these tables that they produce, they think that investment demand will actually be, and it's not included in the sort of the main numbers, but if you include investment demand, let's say, which would go, especially the investment demand that goes into silver ETFs, they've actually doubled their forecast from 50 million ounces of silver to 100 million ounces of silver. So if you include that, you're actually somewhere very close to the record deficit that we saw in the last 5 years. So again, it's how you look at the numbers. Some will argue that they don't want to include investment demand in silver deficits because technically that silver is always available to come back to market to feed supply. I'm not so convinced of that. I think that a lot of the silver buying, ETFs is one thing, but the physical silver buying, I think much of that, once it's purchased, it comes off the market and it's going to stay off the market for a long time. I think, you hear about these silver stackers that buy and buy and buy and never want to sell. Ultimately, eventually, they will sell. Some will sell earlier than others, but I think on average, for the most part, we're only going to see that silver come back to market at considerably higher prices. I think we need to be, somewhere near 40 and well north of 40 before that starts to come back to market. It'll probably even only trickle in. So I wouldn't look to that to help meet deficits anytime soon. So for me, that helps, paint a very, very bullish picture on the supply-demand aspect.
Yeah, I think that gives a good idea of those numbers and how we can look at them in some different ways. So I won't keep you too much longer. I know we've got to send you back out onto the floor of PDAC. But since we're here, I've been asking people who I talk to, how much room in your portfolio do you have right now to be, how much cash do you have to deploy? It seems like a lot of people come here and it's a little unfortunate because they're so packed already.
That's true. That's a good point, because if you're bullish and you've been bullish for some time, odds are that you've allocated a fair bit of your capital. I will say this, that last year alone, or in the past year, in silver stock investor portfolio, we've had I'm going to say 4 or 5 companies that have done really quite well. A couple of them have more than doubled. Some of them were owned prior. A couple have only been owned for a matter of a few months, which was just tremendous. So I always say that, you get a double, take half off the table, sit on that cash. I think that within the next sort of month or couple of months, some people are worried. I think that it's probably a lack of experience to see silver and gold come back and they're starting to panic. And for me, it's just, hey, you're getting a better opportunity to buy this and buy the stocks at a little bit better price, because many of them have had quite the run for the past year. So if you've been looking to deploy, I think we're getting to the point now where the timing looks really quite good. Again, maybe it's a matter of a month or a couple of months. I think we're going to see that bottom. I'm not concerned, neither for the metals nor the miners or the explorers, that we're going to see any kind of a dramatic sell-off. I would look to be deploying actually quite soon.
Okay, good to get that perspective as well. And any final thoughts you would leave investors with?
I was listening to Eric Sprott this morning. There was a packed room. There must have been, I don't know, maybe 800, 1,000 people practically in that room, just sort of eyeballing it. And, something that he said probably 3 or 4 times was, be patient. And, in my presentation back in January when we last spoke, my last slide was, patience is the rarest commodity. And I believe that. And I think that that's one of the biggest enemies that investors have today. They want to make the quick buck, but the big money is made over time. And, look for deep value. And, Eric, if you have the chance to listen to his talk, he gave all kinds of ways that, and tricks and ideas. And I mean, he's one of the most successful and best-known resource investors. He's almost single-handedly, with a few colleagues, supported the entire industry for practically a decade. So this is the kind of guy you want to listen to and understand and get some insights from. And he said, there's so much deep value there, things that are being missed by others. One example was, you've got projects that are valued at much lower prices, metals prices, than where we're at right now. Maybe $20 silver, maybe $2,000 gold, when we are, in silver we're 50% above that. In gold we're almost 50% above that. If you take, if you're bullish enough, and I'm very confident that we're going much higher in both metals. So if you're at least confident enough that these current prices are going to be sustained, and you take those prices and then you do your own calculations on those projects, on either the deposits, the value of the deposits, or the potential cash flow. I mean, what the public's missing, and this is in the fine print in these presentations, that that they've used these much lower numbers to value these projects, that the potential is a multiple of what sometimes it looks already very bullish. And so you have to do a little bit of that research yourself, be selective, look for risks, and then deploy, and then be patient. And I think that ultimately, we're back near where we were back in, say, 2000, 2001, when the tech bubble popped, and we had a decade of just tremendous returns in this sector. And I think we're at a very, very similar time right now. And if you want to look for value and minimize your risk, it's hard to find a deeper value sector.
Okay, well, I think that's a perfect place to leave the conversation for now. Thank you so much for coming on to go over what's happening in silver. This was really good.
Thank you, Charlotte. Always a pleasure.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Peter Krauth.